When you think about it, the global economy is just staggering. Trillions of dollars, millions of products, countless investments zipping across borders every single day. It feels like total chaos, right? But what if I told you there's a master scorecard, a system that tracks every single move? Well, today we're going to pull back the curtain and see exactly how it works.
I mean, really, how does an entire country keep track of all that stuff? Think about it. Every single car that's imported, every piece of software sold overseas, every time a foreign investor buys a government bond. It just sounds impossible, doesn't it? But believe it or not, there's a surprisingly elegant answer to this gigantic puzzle, and it's something the world's economies absolutely depend on.
And that answer is the balance of payments, or BOP for short. The best way to think about it? It's basically a country's ultimate financial scorecard with the rest of the world. Yep, it's the master list that tracks every single dollar, euro, or yen that comes in and every single one that goes out. All right, so here's what we've got on tap. First, we'll talk about why this scorecard is such a big deal. Then we'll break down its two main parts and see how they have to balance each other out. After that, we'll see how this whole thing actually affects your wallet. And finally, we'll dive into the huge debate about the global money maze. Let's get into it. Okay, first up, a nation's global scorecard. So let's talk about why this isn't just some dusty old accounting sheet. This thing matters a lot to pretty much everyone. So why are governments, big banks, and huge corporations watching the BOP like a hawk? Well, because it's basically a crystal ball for the economy. If you're an investor, it's giving you clues about where a country's currency is headed. If you're a multinational company, it might warn you that a government is about to slap on new controls and, lock up your profits. And for everybody, it's a huge indicator of a country's short-term economic health. Get this wrong, and we're talking billions of dollars on the line. Seriously. All right, let's break this thing down. At its core, the BOP is split into two major accounts. And honestly, the best way to get your head around it is to just think about your own money, right? You've got your day-to-day cash flow, your paycheck coming in, bills going out, and then you've got your investment portfolio, your retirement account, maybe some stocks, the long-term stuff. A country's finances, they're split in almost the exact same way. So on one side, you've got the current account. This is all about the here and now. It's tracking all the goods and services a country is buying and selling this year. We're talking cars, oil, but also things like tourism, consulting fees, software, the whole shebang. Then on the other side, there's the financial account. This one is all about ownership. It tracks the buying and selling of long-term assets. Think a foreign company building a brand new factory or a pension fund buying up another country's government bonds. Let's make this real with an example. Take a look at the U.S. current account. It's really a tale of two economies. See that surplus in services? That's America's strength, exporting things like software, finance, and Hollywood movies. But then you look at the trade in physical goods, and it's the complete opposite story. The U.S. buys way more stuff from the world than it sells, and that gap, that deficit, has been getting bigger and bigger. Okay, now let's flip over to the financial account. That steadier line there, that's what we call direct investment. This is the solid, long-term stuff. A company deciding to build a factory, for example. It's a real commitment. But then, look at that other line. The jagged, crazy one. That's portfolio investment. We're talking stocks and bonds. This is often called hot money because it can flood into a country one minute and then rush right back out the next. It is way more volatile. Okay, this next part is maybe the most important concept in this whole explainer. It's the big secret of the balance of payments. These two accounts we've been talking about, the current and the financial, they are not separate things. Not at all. They're two sides of the exact same coin. And here's the kicker. They have to, by definition, balance each other out. And this chart, this just shows it perfectly. Look at that. The U.S. is running this massive current account deficit, meaning it's spending way more money out in the world than it's bringing in. So you have to ask, how is that even possible? Where does the money come from? Well, just look at the other line. It is an almost perfect mirror image. That's the financial account surplus. So what does this mean? It means the rest of the world is taking all those extra dollars and investing them right back into the U.S. They are funding the gap. One account's deficit is the other account's surplus. But there's always an exception, right? And in this case, it's China. For a long time, China did something that seems to break the rules. It managed to run a twin surplus. Think about that. It was selling more to the world than it was buying, and it was attracting more foreign investment than it was sending out. This totally goes against that mirror image thing we just saw with the US. And this unique situation is exactly how China managed to pile up trillions and trillions of dollars in foreign reserves. Now, you can imagine trying to track every single dollar flowing across the planet. It's not going to be perfect. There are always going to be some discrepancies. So accountants have a clever little fix. It's a line item called net errors and omissions. It's basically the official way of saying, hey, we know some data is missing, and it acts as a plug to make sure that in the end, the whole thing does what it's supposed to do, balance perfectly to zero. Okay, so we've gotten through the what and the how. Now for the big one. So what? Why should you care about any of this? Well, believe it or not, these massive global accounts have ripple effects that reach all the way down to your wallet. Because here's the thing, a country can't just keep running these huge deficits or surpluses forever without something giving way. So what happens when these massive imbalances just go on and on and on for years? Well, the consequences can be huge. For starters, a country that's constantly running a deficit might see its currency get weaker. That means all those things you love to buy from other countries, they start getting more expensive. And remember, to fund that deficit, the country has to attract foreign money. And what's a great way to do that? Raise interest rates. But when that happens, your mortgage, your car loan, your credit card debt, it all gets more expensive too. So yeah, there's a real trade-off. Cheap imported goods are nice, but the flip side can be a weaker dollar and higher borrowing costs for everyone. And here's something really interesting. These changes don't happen instantly. Economists have a name for it, the J-curve. So let's say a country's currency drops in value. In theory, that makes its exports cheaper and should help fix a trade deficit. You'd think the deficit would start getting better immediately, right? Well, nope. In the short run, it actually gets worse. Why? Because the country is still locked into contracts to buy imports at the old price, but now it has to pay for them with its weaker currency. It's only later, once new trade deals are made and people start buying more of the now cheaper exports, that things finally turn around and the deficit improves. It creates this distinctive J shape on the graph. All right, all of this leads us to our final and maybe biggest topic, the global money maze. We're zooming out to look at the huge, high-stakes debate over whether capital, money, should be allowed to flow freely across borders at all. You know, today we kind of take it for granted that you can invest your money anywhere in the world, but this whole idea of freely flowing capital, it's actually a pretty recent experiment. If you look back through history from the gold standard all the way through the Bretton Woods system after World War II, capital flows were pretty restricted. The floodgates really didn't open up until the 1970s, and huge players like China and India only really opened up their markets much more recently. So when a government wants to manage this flow, what do? The main tool in their toolbox is something called capital controls. And it's exactly what it sounds like. Any kind of rule or restriction that a country puts in place to limit, slow down, or even change the direction of money moving across its borders. And this gets us to one of the central arguments in all of global finance. Is this free flow of money always a good thing? I mean, is it an engine for global growth, or can it be a source of incredible instability and chaos? As you can probably guess, the answer is complicated. So why on earth would a country ever want to slam on the brakes and stop money from coming in? Well, there are a few big reasons. Sometimes they want to stop that volatile, hot money we talked about from creating a dangerous economic bubble. Or if there's a crisis, they might need to stop what's called capital flight. That's when everyone gets spooked and tries to pull their money out at the same time, which can totally crash an economy. Sometimes it's even about national security, restricting foreign ownership of sensitive industries. It's always this tricky balancing act between being open for business and protecting your own stability. And so that leaves us right here with this fundamental question for our deeply interconnected world. Should capital be controlled or should it be free? On one hand, you have the argument that free-flowing capital is the lifeblood of the global economy, sending money to where it can do the most good. But on the other hand, there's a powerful warning that without any guardrails, that same flow of capital can lead to devastating booms and busts. There's no easy answer here, and it is without a doubt one of the biggest debates shaping our global economy, today and for the future.